What is up, everyone? Welcome back to my next video. And I know why you're here. It's because you want to know what you need to know before you buy a house, before you even start looking for houses. We're going to go over what you need to know to make sure you're prepared to go down that path. So guys, let's get to it. All right, so one of the first things your agent, or a good agent will do at least, is make sure you are a pre-approved buyer. So what that's going to do is you're going to get pre-approved by a lender to tell the seller that you guys are good to go. You have the qualifications to be even looking to seriously purchase a house. And a few things go into how much you're pre-approved for. But when going to get a mortgage, the lender is going to look at two main things and a lot of others, which make up the other things. Hopefully I didn't lose you there. So the first thing we're going to talk about is debt to income ratio, or DTI for short. So your debt to income ratio is going to be, it's a ratio, so bear with me. We're going to have to do some math here. So the formula is total monthly debt expenses. So any current mortgage payments or rent payments, student debt, credit card debt goes in the numerator. And the total gross monthly income is going to go on the denominator. And when you do that equation, it's going to equal a percentage ratio. And we're going to go over the certain numbers that lenders look for. So the standard ratio, that is the upper limit, is 43%. So that 43% number, what it means is 43% of your monthly income is going towards debt expenses, right? So it's not, 43% is not going in your pocket. 43% of your monthly income is going towards paying off other debts. Now guys, this is important to note that it doesn't include expenses. It does not include, your Spotify or your Netflix. We're not counting that. We're just counting major debt payments right now, if you have any, because they're going to look at how much debt you're spending every month to basically, make themselves comfortable with how much they're willing to lend you. So out of that 43%, they like to see no more than 28% of that currently servicing a current mortgage payment or rent payment. But most lenders typically prefer less than 36%. So 36% of your total gross monthly income is going towards servicing debts, and that still includes 28% going towards a current mortgage or rent payment. So you have that extra 8% that can go towards other things, such as, if you're in credit card debt or anything like that, they're okay with seeing 36% or less. Ideally, 28% going towards current payments. So guys, as you can probably figure, the lower the ratio is, the better, and the more willing lenders are going to be to lend, because they know that you are financially responsible and you haven't gotten yourself into debt, really. You haven't gotten yourself into so much debt that you're going to bury yourself and you're going to default on your mortgage. So they want to make sure that they themselves are comfortable with lending out to you. And along with the debt to income ratio, they're also, of course, going to look at that magical number known as your credit score. So as you can probably guess, the higher your credit score is, the lower your interest rate quote will be. And that is pretty much universal throughout all lenders. The better your credit score, the more confident they are that, you are going to perform and you're going to not miss mortgage payments, and they're comfortable giving you a lower interest rate because you're a lower risk individual. And of course, vice versa, the lower you are, more likely the higher the interest rate's going to go. All right, everyone. So the next topic we're going to talk about is how much down payment you can actually afford. So the conventional mortgage is 20%. That is the go-to number that every lender tries to get if they can get it, because they know the more money you put down, the less risk they're taking, because it's less money they're lending out on the purchase price. So typically it's 20%. Now, you yourself have to come to terms with if you're financially capable of putting down 20%. Now, there's pros and cons of putting down different mortgage payments, and if you put down less than 20%, you are almost guaranteed to be carrying private mortgage insurance, also known as PMI. So if you put down less than 20%, you're going to have to carry this insurance, which ranges from about a 0.5% to 1% of the total mortgage amount. So on a $300,000 house, you're going to be paying $1,500 to $3,000 a year in mortgage insurance. And at the end of the day, it's really not the end of the world, because let's say if you have 20% and you only put down 5%, or maybe even less, you go the FHA route and you put 3.5% down. If you can take that lump sum payment and get a better return on it elsewhere, then that $1,500 to $3,000 is already paid for itself, basically. So it's really up to you and what you're comfortable with. Now, mortgage lenders are more comfortable with you putting down more money, as well as it is considered a stronger offer if you have more money down, because the seller will know that you are serious about buying this property and that you can perform. So also, guys, it basically comes down to what you're comfortable with and what you're financially capable of spending. If you go the FHA route and you put less money down, lenders might be a little more selective and you might not be able to get a loan from anyone. You might have to take a little bit more time to find one. So it boils down to what you're comfortable with. And guys, don't drain out an emergency fund or any sort of funds that you will need one day just in case anything happens. God forbid there's another thing like happening right now. If you get furloughed and you don't have unemployment right away, you're gonna need a little cash to get you through some uncertain times or repairs or anything like that. So be responsible, whatever you're comfortable with. Don't drain out your emergency fund or anything like that just to afford a 20% down payment. All right, so the next thing you're going to want to stay up to date with is the economic outlook and what's currently going on in the economy. So right now, obviously, we're in a lot of uncertain times. The market's pretty volatile right now, but one thing that is constant is the mortgage rates. So mortgage rates are at, I feel like everyone says this, but they're at all-time lows. Your mortgage rates are really good right now. So yes, most houses you are paying a premium right now because there's so little supply, but sometimes that can outweigh itself with how low you'll be paying in interest. So there's a break-even point and you might actually be coming out ahead paying a little more for a house but having a lower interest rate than, if we weren't in these times and the prices were back down a little lower, then paying that and having a higher interest rate. So it is very important to keep track of interest rates and what is happening. And also, the time of year is also going to play into searching for a house. So the market typically tends to ramp up in the spring because the school year is finishing and parents want their kids to finish out the school year and then move and settle in for a new school for the new school year. So the market tends to get hot around then, and it tends to cool off pretty much right about now. So the fall and winter, things tend to cool down because, the holidays are coming and people want to get out their holiday decorations, not necessarily pack them and move, because they have a lot going on with the holidays and family and school and everything like that. And the last thing is, guys, make sure you know your lifestyle needs and how much house you really want and how much house you can actually afford. There's a saying called house poor or house rich, cash poor. There we go. House rich, cash poor. And pretty much what that implies is you're spending so much on a home you didn't necessarily plan on that you have no monthly cash flow coming in. It's all going out. So you should see what you can afford, that 28% number. Keep in mind, that 28% of your gross income should be strictly towards a mortgage payment. But also keep in mind that whatever house you get, you're going to have property taxes, you're going to have homeowners insurance, you're going to have utilities, you're going to have maintenance and repairs. So that 28% can really sneak up on you really quick. And then you have your other expenses, your personal living expenses. So it can eat into you pretty quickly. So I really would recommend is take some time and really dive into the numbers a little bit to make sure that you guys are not handcuffing yourselves and really limiting yourselves on the cash flow and how much you're going to tie up into a home. So one of the best things you can do that I would strongly recommend is do a little self-audit of yourself. So take a month or two of expenses, go through them, and see what your debt to income ratio actually is to prepare yourself for what lenders are going to look at. Also, an easy thing to do is pull your credit score. Doesn't cost any money, and it's really good to know about where you're at and if you can improve in any way if your credit score is lower than you want it to be. So just some quick tips, and they're really easy to do. So guys, I hope that was helpful. Thank you for watching. Jared Bruno from Remax Hometown Realty. I will catch you all on the next video. Don't forget to like, comment, and subscribe, guys. Thank you. Till next time.